So when a massive multi-billion-dollar corporation announces a huge stock repurchase plan, what's the first thing that usually happens?
The market cheers almost instantly.
Right, the stock price jumps. And we, as investors or just observers, we tend to see this as a great sign. Management is rewarding shareholders, almost like they're scattering cash from a helicopter.
It feels like a huge vote of confidence, but
Yeah.
that immediate celebration is exactly where we need to pause and think a little more critically.
Okay, so that's our mission for this deep dive.
Exactly. We want to give you a really simple but powerful tool to figure out if that buyback is actually sweet honey for you, the shareholder, or if it could be, a huge trap, a kind of poison for the company's long-term value.
So we're looking for a way to judge whether they're actually earning us money or just destroying value in plain sight.
Precisely. And our analysis today, it's all built from some great financial sources that offer a really streamlined way to think about this.
Perfect for our audience.
And before we get into the numbers, just the usual quick note. This is all based on publicly available information. It's for educational purposes to help you think like an owner.
It's not investment advice.
Absolutely not. You always have to do your own due diligence. And speaking of which, for those of you who do like to track the big picture, the sort of total market temperature,
Right.
we always recommend checking out our sister app, Buffett Indicator. It's on the Apple App Store, and it's a great tool for monitoring that overall market sentiment.
Okay, perfect. So let's unpack this. Where do we start to get our heads around the core logic of a buyback?
Let's start far away from Wall Street. Let's use a really simple analogy. Imagine a pizza parlor.
A pizza parlor, I like it.
The whole business is valued at, say, $100, and there are 4 equal partners.
So each partner's share is worth $25. Simple enough.
Now, the pizza shop has done well. It's got some extra cash in the register, maybe $50, and the partners decide, let's do a buyback.
Meaning they're going to use the store's cash to buy out one of the other partners.
Exactly. And whether this creates value or destroys it for the 3 who remain, well, it all depends on the price they pay.
Okay, so let's take scenario 1, the good one.
The good one. Let's call it the sweet honey scenario. One of your partners has to move out of town suddenly. They need cash fast. They're a motivated seller.
So you negotiate.
You negotiate hard. And the store uses only $20 of its cash to buy back their share.
Wait, a share that we just established has an earning power of $25.
Exactly. The company just spent $20 to acquire a $25 asset.
That's a bargain. The remaining 3 partners just got richer.
Instantly. Their slices of the pie are now bigger, and the pie itself is more valuable because the company made a smart, profitable investment in itself. That's value creation.
Okay, so that's the honey. Now for the poison. Scenario B.
Scenario B, value destruction. This time, the partner you want to buy out is greedy. They know the store is flush with cash, and they drive a hard bargain.
And maybe there's hype. Everyone's saying it's the best pizza in town.
Right. And for whatever reason, the store is forced to pay $40 from the register to buy that same share.
The one that's still only worth $25 in real earning power?
Yes.
That's a terrible deal. You're throwing away money.
It's a disaster for the remaining partners. The store's cash, its most flexible asset, is now seriously depleted. That $40 could have bought a new oven, paid down debt, maybe opened a second location.
Instead, it was just burned on an overpriced internal deal.
And that right there is the entire logic of the stock market. The logic is identical. A company is using its cash to buy back a piece of its future earnings. The whole problem for us as investors is figuring out, are they paying $20 or are they paying $40 for that $25 of value?
That's the perfect way to frame it. And it brings up an immediate question for me. Everyone talks about the PE ratio, the price to earnings ratio. Isn't that what management is looking at?
They are. And PE is a great valuation tool. But it doesn't really tell you the rate of return on an investment. And a buyback is an investment. When a company spends its cash, it's making an investment decision. You have to frame that in terms of yield. What's my return?
Which brings us to the key metric, the tool that cuts right through all that noise.
Earnings yield, or EY.
EY.
The beauty of it is its simplicity. It's just the inverse of the PE ratio. So instead of price divided by earnings,
You flip it. It's earnings per share, the EPS, divided by the stock price.
and that simple flip transforms the whole conversation. You're no longer talking about a valuation multiple. You're talking about a rate of return, an investment yield.
Let's run the numbers on this using the cases from our source material so everyone can see how powerful this is.
Okay, case A. Let's say the stock is fairly valued. The price is $100. And the company's earnings per share, its EPS, is $5.
Right, so the PE ratio is 20. 100 divided by 5. Seems reasonable to a lot of people.
But we're not looking at that. We're calculating the earnings yield. So we take the $5 in earnings.
And divide it by the $100 price, which gives us 5%.
5%. That is the critical number. It means for every $100 the company spends buying its own stock, it's buying back $5 of permanent annual earning power for the shareholders who remain.
So it's like an internal investment that yields 5%.
That's exactly what it is. And now you have a hurdle rate.
A benchmark. For this buyback to be a smart move, that 5% return has to be better than anything else they could do with that $100.
Precisely. You have to compare it to their opportunity cost. For example, what if they have debt that costs them 6% in interest?
Well, then paying down that debt would be a better use of the money. A 6% return is better than 5%.
What if they could build a new factory that's projected to return 12%?
Then the buyback looks pretty lackluster.
But what's the most basic fundamental comparison? The absolute floor.
The risk-free rate. What they could earn just by putting that cash in the bank or in a treasury bond with zero risk.
And that's the aha moment. Let's say the risk-free rate right now is 4%. The buyback yields 5%. The risk-free rate is 4%. In this case, the buyback is still creating value. That 1% spread might not be huge, but it's profitable. It's a smart, if not spectacular, use of capital.
Okay, I'm with you. Now for the danger zone, case B. What happens when that stock price gets inflated?
The stock is riding a wave of market hype. The underlying business is the same. EPS is still $5, but the stock price has shot up to $200.
So the PE ratio is now 40, which should already be a red flag.
A huge red flag. But let's look at our number, the earnings yield.
It's $5 in earnings, now divided by a $200 price. That's 2.5%.
2.5%. Now compare that to our risk-free rate,
which we said was 4%.
The company is spending $100 of its flexible, valuable cash to get a permanent return of just $2.50.
When they could have put that same $100 in the bank risk-free and earned $4.
They are actively destroying $1.50 of shareholder value for every $100 they spend, compared to the safest possible alternative.
That is, wow, it's so clear when you frame it that way. Management is swapping high-yielding cash for their own low-yielding, expensive stock.
From a capital allocation perspective, it's indefensible. And that's why earnings yield is the tool. It just strips away the emotion and the hype and gives you the cold, hard rate of return.
But this raises the big question. If the math is that simple and destroying value is that obvious, why would smart, highly paid CEOs keep doing it? Why buy back stock at these inflated prices?
And now we move from the world of pure mathematics into the world of, well, human incentives.
The agency problem, where management's interests might not be the same as the owner's interests.
That's the heart of it. The sources are very clear on this. The main reason for these high-price buybacks is often not about creating long-term value for you. It's about the immediate impact on executive compensation. Because executive bonuses, especially on Wall Street, are very frequently tied directly to one specific metric: earnings per share growth. The faster EPS grows, the bigger the bonus.
Okay, let's break down the math there because it's a bit of a trick. The formula for EPS is net income, which is the company's profit,
Numerator.
divided by the total number of shares outstanding.
The denominator.
So when a company does a buyback, they are using cash to reduce the number of shares. They are shrinking the denominator.
And there's the magic trick. Even if the company's actual business, the net income, the profit, doesn't grow by a single penny,
the EPS number has to go up because you're dividing the same number by a smaller number.
the optics are fantastic. The quarterly report comes out, it shows great EPS growth, management hits their targets, and the CEO gets a very nice annual bonus.
But the company itself is no richer.
In fact, it's poor. They spent valuable cash on an overpriced asset. They didn't grow the pie. They just cut the existing pie into fewer slices.
And the knife they used to cut it, that capital, was used at a pathetic 2.5% return when it could have safely earned 4%. It's a short-term game that puts compensation ahead of smart investment.
Absolutely. And you have to remember, the board of directors is also under pressure from activists, from the market, to deliver that predictable EPS growth. So they sign off on it because it's the easy way to get that number up and satisfy short-term demands.
So wrapping this all together, what's the big takeaway for us? The good news here seems to be that you don't need to be an insider to see what's going on.
Not at all. We have the simple calculator, the earnings yield. It lets you check their homework.
Right, so stock buybacks aren't just good or bad. It's not a black and white issue.
It's a tool. And its value depends entirely on the price paid. You have to look at their purchase of their own stock like you would look at any other acquisition they might make. Is the price right? Is return good?
So the actionable step here is, next time you hear a headline about a huge corporate buyback, don't just cheer.
Don't just rush in. Take 30 seconds. Pull out your calculator, find the company's EPS, and divide it by the current stock price.
And that gives you the earnings yield, the real return on their investment.
And here's a final thought for you to mull over. If that yield you just calculated is significantly lower than the interest rate you could get on a simple, safe government bond, the risk-free rate, what does that tell you?
It tells me they're choosing a lower return investment over a higher return, safer one.
It suggests the primary motivation might be using your shareholder funds to juice a metric that pays management's annual bonus, rather than to genuinely reward long-term owners. And that's the difference between being a passive spectator and a smart, engaged owner.